Happy Thursday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. Let's jump in. The fragile truce between the United States and China is under renewed pressure as U.S. President Donald Trump yesterday evening launched a sharp, late-night rebuke of Chinese leader Xi Jinping, calling him, quote, very tough, end quote, and, quote, extremely hard to make a deal with, end quote, in a social media post. The comment, made on Trump's Truth social platform, comes as tensions escalate over stalled mineral shipments, expanding export controls, and geopolitical flashpoints such as Taiwan. At the heart of the conflict is the deepening trade and supply chain rift. Following a brief detente reached in Geneva last month, where the two nations agreed to lower tariffs and ease restrictions on key exports, U.S. officials now accuse China of failing to uphold its end of the deal. In particular, Beijing has reportedly continued to restrict shipments of rare earth magnets, critical components for everything from smartphones to fighter jets. Quote, China has totally violated its agreement with us, end quote, Trump posted a few days earlier, accusing Xi of backtracking on commitments made during the Geneva talks. U.S. Trade Representative Jamison Greer echoed the sentiment, stating that Beijing is, quote, slow-rolling their compliance, end quote. The friction over rare earths has exposed a strategic vulnerability in the United States. As we discussed in greater detail in yesterday's episode of my other channel, China Update, China mines 70% of the world's rare earths and processes 90% of them. These minerals are critical not only to consumer electronics, but also to national defense and clean energy industries. Recent Chinese export controls have already disrupted U.S. supply chains, forcing companies like Ford Motor to temporarily halt production due to shortages. The rare earth magnets problem is getting so bad that, according to US-based The Wall Street Journal, some automakers and their suppliers are thinking of, quote, producing electric motors in Chinese factories or shipping made-in-America motors to China to have magnets installed, moving production to China as a way to get around the export controls on rare earth magnets. End quote. In response, the Trump administration has imposed fresh export bans on jet engine components and chip design software, suspended certain technology licenses, and begun exploring domestic rare earth mining projects. As we discussed on China Update, however, even if there was a Manhattan project-level speed applied to this change, it could be months, if not years, before a lot of these supply chains in critical minerals are moved closer to North America. Indeed, analysts warn that rebuilding such supply chains will take years and cost hundreds of billions of dollars. Quote, the supply chain wars we've been speculating about for years are now happening, end quote, said Lisa Tobin, a former White House National Security Advisor, adding, quote, it's a battle over strategic leverage. End quote. While markets have so far shrugged off the latest flare-up, Chinese stocks traded in Hong Kong dipped only slightly. Corporate anxiety is growing. The licensing system China uses to approve mineral exports remains slow and opaque, with some US firms reporting preferential treatment for European competitors. However, Europeans have also complained that they're facing tough barriers to getting their rare earths from China as well, with one official stating that it's the worst case of Chinese economic coercion he has ever seen. Meanwhile, prospects for a direct Trump-Xi call remain uncertain. The White House insists a conversation is likely this week, but Chinese officials have offered no confirmation. Washington-based commentators report that it could happen this week. Trump has long emphasized personal diplomacy with Xi as a key to resolution, even expressing willingness to travel to China. But with both sides accusing each other of bad faith and mutual distrust running deep, a near-term breakthrough appears unlikely. As Albright Stonebridge Group observes in a note today, quote, this problem is deep and long-lasting. It will not go away or be easily solved. End quote. Next up, let's move to Asia, and specifically to Japan. We'll touch on something a little bit lighter. Excitement is building for the Nintendo Switch 2, with the $450 console launching today, Thursday. The global launch marks one of the biggest gadget launches in years, recalling the first day mania surrounding the iPhone of a decade ago. Due to tight production constraints, the Kyoto, Japan-based gaming company Nintendo has imposed strict purchase limits domestically, prompting major retailers to implement a lottery system requiring a history of purchases and membership via apps or store credit cards. Over in the US, GameStop and Best Buy have both said that they expect the Switch to sell out on the first day. The Switch 2 closely resembles its predecessor but comes with upgraded performance and modest innovations, such as a new controller with mouse-like functionality and voice chat. According to the CEO of Kantan Games, quote, "It's a very similar product, just a lot more powerful," end quote. He believes Nintendo is intentionally playing it safe to avoid past missteps like the Wii U, which flopped after the blockbuster success of the Wii. And the stakes are very high. The gaming industry is bigger than the film, music, and television industries combined. At a time of thinning margins and exploding budgets for new game productions, Nintendo's new console is a watershed moment for the industry, as it may steer business decisions by partners and competitors for years to come. Analysts are generally optimistic. Nintendo forecasts sales of 15 million units in its first year, matching initial Switch numbers. Hideki Yasuda of Toyo Securities describes demand as, quote, unprecedented, end quote, particularly at a time when gamers are playing fewer new titles and industry revenue is slowing. Unlike competitors who rely heavily on third-party titles, Nintendo's strength lies in its in-house franchises, Mario, Zelda, and Donkey Kong, which accounted for 73% of software revenue last fiscal year. This internal ecosystem, combined with cost-effective hardware design using NVIDIA chips, allows Nintendo to sidestep the high-spec arms race dominated by Sony with its PlayStation and Microsoft with its Xbox. Still, challenges loom. The company faces possible tariff impacts under U.S. trade policy, with President Trump's reciprocal tariffs threatening supply chains in China, Vietnam, and Cambodia. Nintendo has already delayed U.S. pre-orders as it evaluates potential cost implications. Meanwhile, and speaking of Japanese companies, shares in Toyota Industries fell 12% on Wednesday after minority shareholders slammed a proposed 5.2 trillion yen, $33 billion, take private deal as deeply unfair and opaque. The backlash marks a major blow to Japan's corporate governance reform efforts and highlights growing tensions around minority shareholder rights. The plan would see 99.44% of voting rights transferred to a new holding company controlled by Toyota Fudosan, a privately held property group chaired by Toyota Motors' Akio Toyoda. Critics argue that the move masks Toyota Motors' role in the deal while entrenching insider control. Although the share offer represents a 23% premium to the pre-announcement price, investors argue it undervalues the company. Asset managers and analysts have described the deal as, to quote their words, shameless, unacceptable, and a governance disaster. Investors are particularly incensed by the lack of transparency and say the deal structure could sidestep upcoming Tokyo Stock Exchange rules aimed at protecting minority shareholders from discounted take-private offers. Toyota Industries defended the pricing, citing financial advisor input and a special committee's assessment. However, the backlash may intensify calls for tighter oversight of corporate governance in Japan's sprawling business groups. Next up, we move to Europe, but just quickly, if you're getting some value from today's episode of China Update, not China Update, it's Market Update. Next up, we move to Europe, but just quickly, if you're getting some value from today's episode of Market Update, don't forget to hit the like button, and if you want to continue to be on top of the most up-to-date analysis on global markets through a balanced digest and grounded in sober analysis, make sure you're subscribed to Market Update. And finally for today, 2 updates in Europe. The UK has been granted a temporary exemption from newly announced 50% US tariffs on steel and aluminium, as the Trump administration cited the need to allow implementation of the US-UK economic prosperity deal. The exemption, however, leaves British producers still facing existing 25% tariffs until the deal takes effect, adding urgency to calls from UK industry leaders for rapid action. The deal, signed on the 8th of May by US President Donald Trump and UK Prime Minister Sir Keir Starmer, promises zero tariff access for UK steel and reduced duties on up to 100,000 British car exports. But negotiations over the implementation have stalled, prompting growing frustration from companies like Tata Steel and Jaguar Land Rover. Industry representatives warned a parliamentary committee this week that continued delays are costing orders and harming transatlantic business. President Trump's executive order included a warning: if the UK fails to meet the deal's terms, especially on excluding Chinese inputs, tariffs could rise to 50%. 50% as early as the 9th of July. Talks between UK Business Secretary Jonathan Reynolds and his US counterpart in Paris offered no clear timeline for resolution. Though not yet legally binding, both governments insist they are working to operationalize the pact, quote, as soon as possible, end quote. Meanwhile, on the continent, things are a little dicier. European governments are entering a critical stretch of negotiations with the US, facing what officials describe as a, quote, perfect storm, end quote, of intertwined crises that could reshape the continent's security, economy, and political future. Over the next 5 weeks, leaders from the EU will attempt to preserve American support on 3 fronts: Ukraine, transatlantic trade, and NATO defense, amid mounting fears that Trump will tie concessions in one area to demands in another. Quote, this has morphed from best-case scenarios to damage control, end quote, said a senior EU official speaking to UK-based The Financial Times on the condition of anonymity, summarizing the mood across European capitals. Quote, on trade, defense, and Ukraine, the choice is between a bad outcome and a very bad outcome, end quote. Officials worry that Trump, who has previously demanded higher European military spending and threatened tariff hikes, could leverage US support for Ukraine or NATO commitments as bargaining chips. Quote, he may try to squeeze us, end quote, warned former EU Foreign Policy Chief Josep Borrell. The EU's worst-case scenarios include a sudden end to US backing for Ukraine, a full-scale trade war, or the abrupt withdrawal of US military assets from Europe. These fears come ahead of a pivotal series of summits, the upcoming G7 in Canada, a NATO gathering in The Hague, and a Brussels trade summit. The tension reflects deep divisions within Europe. France's vision for a more autonomous Europe has gained momentum, but other member states, especially those closer to the front lines of Russian aggression, remain adamant that preserving the US alliance is paramount. Italian Prime Minister Meloni, viewed as one of Trump's closest European allies, urged a pragmatic approach, expressing this week, quote, the dialogue with Washington must be carried out with wisdom and common sense, end quote. Yet the EU's options are limited. Ambassadors have warned that pushing back in one area could provoke retaliation in another. Quote, we see Ukraine defense trade as separate issues, end quote, one diplomat said. It's not clear whether Washington will agree. With no consensus on how to respond and trust in transatlantic stability fraying, EU leaders face an uncomfortable truth. As one EU official admitted to the Financial Times this week, quote, yes, we are in big trouble, end quote. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Thursday, and I will see you for another episode tomorrow.